Hello and welcome to the next installment of PwC webinars in English, webinars regarding tax changes. My name is Marcin Jaworski and I have the privilege of hosting most of these English-speaking webinars, and today I'm joined by Michał Małkiewicz.
Good morning, everyone.
Hi, hello. I'm a senior manager in the tax department in the corporate tax team of PwC. Michał is more working with international taxation, and today we will be discussing a number of changes in the Polish corporate income tax legislation that are planned for 2021. Some of them from January, some of them later on. We will see how these changes are implemented and from which period exactly, because this is an extremely busy time for corporate income tax lawyers, for people dealing with corporate income tax, for accountants. There are changes to the planned legislation basically introduced daily. We had a presentation, I think, last week on Tuesday, which was very fresh, and there were a lot of fresh changes introduced then. We had some changes to these planned changes as far back as yesterday already, I think. So there's still a lot of work going on in the legislature, a lot of work on these amendments, and these amendments are really numerous. Okay, so here we have the agenda. There are sort of 8 larger groups of changes that we'll be discussing, and we'll be splitting these between ourselves. And there's also a group of following smaller changes, but they also may have and will have an impact on some of you, on some of the taxpayers in Poland. So I think, without further ado, I can relay to Michał, who will be discussing the first of these changes. We'll be discussing first taxation of limited partnerships. Then we will be discussing so-called Estonian CIT, a very interesting new vehicle, which is aimed at promoting investment, mainly in tangible assets, but to promote investment in Poland, a sort of vehicle similar to the Estonian CIT or having the same goal. So promotion of investment, which is the special investment fund. There will be a huge batch of changes regarding real estate companies and transactions with respect to real estate. So this will be one of the bigger blocks of our today's presentation, of our today's meeting. Subsequently, a change I think affecting mostly the largest taxpayers, so the obligation to publish the report on the realization or the fulfillment of their tax strategy. Then another promotional vehicle, another vehicle for promoting investment, the robotization relief, and then some other changes. So as you can see, the agenda for today is pretty packed. So I think we will not be able to go into a lot of detail on a lot of these points, but we have our moderators on the chat. So if you have any questions that you would like to ask, please ask them during the chat. Unfortunately, due to the circumstances, this is the formula the only formula that we have available for contacting you, our dear clients. So if you have any questions, we cannot answer them live, unfortunately. But ask them on the chat, and we will either answer them during the chat during this meeting or come back to you afterwards. Oh, just one final thing, perhaps before Michał starts to get into the details. At the end of the presentation, we will have a question for you. So please stay with us when we are discussing this question, and I think the answers to these questions will be also valuable for you. So please stay until the end, and and I think now it's time for the first of the topics, the taxation of limited partnerships. And please, Michał, go ahead.
Thank you, Marcin. As Marcin noticed, first we'll start with quite a big change, change that is one of the most debatable right now among those different amendments in the corporate income tax law. The change regards the limited partnerships, so the companies that are tax transparent in a way that only the partners of limited partnerships are subject to tax at the moment. And the Ministry of Finance, the legislator, noticed that this type of vehicles, legal entities, could potentially be used for aggressive tax planning in a way that very often limited partnerships, as you know, were consisted of, had a structure whereby the general partner was a limited liability company and the limited partner was a natural person. As a result, it was possible to achieve a situation of a single taxation at one level, and at the same time to keep the secure attributes of the limited liability company, so limited liability for the obligations of the company. And in order to address this the situation, the new legislation that is put in place, the draft bills, proposes to include limited partnerships in the scope of corporate income tax law. So the limited partnerships as of 1st January 2021 or as of 1st May 2021, depending on within the current wording of the draft bill, the taxpayers will have a freedom to choose between these two dates, will become simply taxable to CIT in Poland. So that's quite a big change that will affect a lot of taxpayers, quite a lot of companies in Poland, small and medium enterprises were using this form of conducting business activity through the limited partnerships. However, at the same time, the legislation proposes certain exemptions, saying that in a case that the limited partnership is not used for abusive purposes, it will be possible for the partners, for the limited partner and for the general partner, to exclude certain income from taxation. So for the limited partners, it will be possible to subject to tax only 50% of income generated through the limited partnership, but no more than 60,000 Polish zlotys. And at the same time, for the general partners, there will be similarly as it is now for joint stock partnerships, to deduct tax paid by the limited partnership from the income that is due on the partner from the income source for the limited partnership. So it's important to know that there are certain exemptions available for the taxpayers to be utilized. At the same time, maybe it's worth also mentioning that general partnerships will be included in the CIT law. This is also something totally new, but only not on general basis, but only in special circumstances. So in a situation where the general partnership is not able to identify and provide information on its direct and indirect partners, shareholders, and that type of situations where the shareholders are not natural persons and we are unable to identify them, then the general partnerships will also be subject to CIT. So this is again something very new and not so far being in the CIT law. And now I will pass the voice to Marcin to present to you more, let's say, positive news on the Estonian CIT and special investment vehicles.
Okay, thanks, Michał. As we discussed while we were preparing for this webinar, it seems that Michał will be discussing the additional obligations and additional burdens which are planned to be introduced for the Polish taxpayers, and I have the privilege of discussing the positive or the more positive aspects of these new regulations. So first off, and I think a general trend can be identified in these changes, being that the Polish legislature plans to incentivize more investment in the Polish economy. So, and first group of these changes is the introduction of the so-called Estonian CIT mechanism, which is in fact not 100% like the Estonian corporate income tax, but has some similarities. So basically, what will be introduced will be the abolishment of general tax obligation, of general tax compliance for entities which will first of all be able to join the so-called Estonian CIT mechanism. They will no longer be obliged to file annual corporate income tax returns to calculate annual tax. They will be taxed only based on their accounting records, accounting results, and what will be taxed will be the profit, generally profit distributed towards the shareholder. So basically, this is a completely new mechanism, which the aim of which is to say, as long as you reinvest what you earn, you will not be paying corporate income tax. As soon as you pay out dividend, you distribute the profits that you have recorded. This is the moment where corporate income tax will be due. Unfortunately, this is not a mechanism available for everyone. It will be available only to smaller local corporate income tax payers, so basically entities with up to 100 million zlotys of revenues. But not only that, these types of smaller entities will have to fulfill certain criteria. First of these is that they cannot be owned by other corporate entities. So basically, these have to be limited liability companies owned by individuals, owned by natural persons. And these same entities are also not allowed to own other limited liability companies, to own other entities. So basically only the simplest possible structure where we have a natural person as a shareholder, and there are no further subsidiaries than the one that is owned by this natural person, are this possibility of joining the Estonian CIT mechanism is available only to those entities. There are also very many additional criteria, additional circumstances, or additional obligations that need to be fulfilled in order for a given taxpayer to benefit from this Estonian CIT regime, like certain employment criteria, certain income criteria. For instance, passive income cannot be the majority of the operations, of the income, of the revenue of these entities. So there are a lot of criteria that have to be met, but basically the principle is, as long as you reinvest, there are also thresholds or levels of reinvestment that need to be met in order for an entity to be able to remain in this Estonian CIT regime. As long as these criteria are met, there is no corporate income tax reporting, there are no corporate income tax obligations. But at the moment, or at the time the reinvested profits, or the profits are distributed to the shareholders, this is the tax point. This is the moment when tax will be due. So basically, as I said, this is a sort of change. This is a very big change for those who will be able to benefit from it, because they will be basing their corporate income tax obligation, either the Estonian CIT regime is basically for 4 years and then can be prolonged, but they will be basing their corporate income tax obligation on their accounting results, more or less, again simplifying by a lot. And the corporate income tax rate for the distributions of profits to the shareholders will be either 15% for a so-called small taxpayer. So according to the changes we will be also discussing during this presentation, up to 2 million euros of revenue, and for other taxpayers, so between 2 million euros and 100 million zlotys, the corporate income tax rate will be 25%. For the smaller ones, it will be 15% generally. However, in the event of investing a lot, in the event of investments exceeding thresholds specified also in very detailed fashion in these regulations, when these thresholds are exceeded, the tax rates will be lowered by 5 percentage points. So Estonian CIT is a sort of Polish version of Estonian CIT, not unlike very many other versions of either EU directives or other, let's say, global solutions. It is a Polish version of this solution, so it has a lot of twists, a lot of details, and a lot of items that differentiate it from the source, from the original. But the general idea is to promote investment in tangible assets, in machines, in fixed assets, by allowing taxpayers who fulfill and exceed the investment thresholds, who are smaller local entities, and not to pay corporate income tax until the distribution of profit is made to the natural person shareholder. An alternative vehicle which is available for these same entities, so it is available again only for the smaller local taxpayers, is a so-called special investment fund. This is basically an additional fund, an additional, let's say, line in the balance sheet, an additional write-off or additional part of capital, which is to be defined as sort of promise of spending a given amount for fixed assets in the future. So basically, these smaller taxpayers can say, okay, we will spend a given amount on fixed assets in the next year, or potentially there is an option to spend these amounts in the next 3 years. And at the time these amounts are sort of destined or ascribed for this purpose and in cash transferred to a defined bank account, this is the moment where these amounts can be deducted for corporate income tax purposes. So basically, investment in fixed assets can be deducted as a one-off, as long as it is presented in the appropriately in the accounts, and as long as a given amount is transferred, and it doesn't have to be deducted via depreciation over the life period of a given fixed asset. So this is an alternative also to promote investment. This is an alternative for these entities which are smaller, so which could join the Estonian CIT regime, but will decide not to. Okay, I think one more point that is also worth mentioning is that generally it can be these changes regarding the taxation of limited partnerships and Estonian CIT and special investment fund can be viewed jointly, and I think this is also why we put them together. The idea could be that a lot of entities which are now operating as limited partnership will transform into limited liability companies and then join the Estonian CIT regime, since it is viewed by the legislature as a preferential tax treatment and as an option for tax benefits. So this is why I think we can discuss these items together. And I think the next point is also concerns fixed assets, but fixed assets of a rather larger proportion. So I think it's time for Michał right now to discuss the real estate companies and real estate clause.
Mm-hmm. in this aspect, it's actually quite a revolutionary change in the Polish corporate income tax law. Simply, what is happening is this amending bill proposes two major things. First of them is modification of the currently existing real estate clause that is already there in the CIT regulation, and at the same time there is a definition of the real estate company that is being introduced for the very first time. As you may know, the aim of the real estate clause is to indicate what type of transactions connected with transfer of real estate will be subject to tax in Poland. So where the Polish tax office, Polish tax authorities will have a right to tax such rights. And on that basis, so simply if the non-resident is selling shares in a company that derives its value primarily from the real estate that is located in Poland, even if there is quite a long connection with those real estates, if certain conditions are met, then such transaction can potentially be subject to tax in Poland. And in order to determine it, we need to add another layer, which is the interpretation of the double tax treaties, which can modify the right to taxation. In many cases, when the double tax treaty does not contain this so-called real estate clause, the right to taxation may be switched to jurisdiction of a non-resident. And still, there are some double tax treaties which do not have such a clause. And with the real estate company, what is happening, and I will talk about it later a bit in more detail, there is this institution of real estate company put in place in order to capture certain transactions connected with companies that own significant value of real estate, in particular commercial ones. Because here the legislator aims not only to include these companies into the scope of real estate clause, but also is changing the methodology of taxation of such entities. So simply that company will become right now the payer of tax. And if we stop for a while at this definition of real estate clause, what is happening? So right now, the regulations are, as you know, in the legislative process. They went through the first reading of Sejm, lower house of Polish Parliament, and they were also referred to the Commission of Public Finance. And last Friday, there were new amendments actually proposed, so they are in a constant change at the moment. But where we are right now, the definition looks like that, in my opinion, it got closer to the original wording of the real estate clause. Why? Because in the previous version, there was a reference made that the right to taxation is in Poland when there is a sale of shares of the company that derives at least 50% of its value from real estate located in Poland. In the previous wording, there was also a reference made to the 12 months period that we need to look at in order to check if the real estate clause is triggered. To give you an example, when there is a transfer of shares of a company that derives value from real estate, on the basis of the double tax treaties, and in the version that is not modified by the multilateral instrument, you look at the point of time when there is a sale of shares to see whether or not we need to tax it in Poland because of real estate clause. And previously there was this 12 months period proposed. As a result of it, we would need to look not only at the moment of the sale of the transfer, but also to check whether within the period preceding the sale, this 12 months period, the value of assets of the company and more than 50% consisted of real estate. So right now we don't have this 12 months period in the proposed legislation. What also changed is a reference made to the market value of the real estate. Right now we don't see it, so it was deleted from the definition. And as I mentioned, real estate companies are within the scope of real estate clause. Again, it will be important to apply double tax treaties as every time in order to check the right of taxation in Poland, because as I said, in some cases, in some treaties, there is no real estate clause provided, and in that case, if conditions are met, if the non-resident is selling and it's not aimed at tax avoidance, the right for taxation will stay with the country of the seller. And as far as the real estate company definition is concerned, the legislator introduced this definition in order to implement this new mechanism of tax collection, about which I will talk about a little bit more later. But this definition of real estate company is very important because we need to verify if within the transfer that is understood quite in a wide sense, it can be a sale, a contribution, etc. The non-resident is transferring shares in the real estate company. And what is it, this real estate company? We have a reference to two possible situations: the companies that are starting their business activities, and in that case, we need to verify if as at the first day of the tax year of that company, the market value of assets exceeded 50% of the total value of assets of real estate located in Poland. And there is also a condition that market value of such asset must exceed 10 million Polish zlotys. At the same time, for the remaining companies, so not the ones that start their business activities, we need to verify the value of the balance sheet value of assets. So whether at least 50% of assets, balance sheet of assets, is directly or indirectly connected with real estate located in Poland. And there is another condition, so we need to read them jointly. The balance sheet value of real estate exceeds 10 million Polish zlotys. And there is another condition that must be met: at least 60% of income of such company must be connected with transactions, let's say, generally connected with real estate. So it could be leasing, subleasing, rental, sale of real estate, etc. So all these three conditions must be met here so that we know that we are dealing with a real estate company. As you can see, there are different words used. So in the first case, we're talking about the balance sheet value. In the other case, we are talking about the market value of the assets. For those companies that continue their activities, we also need to test this percentage of income achieved. So here we'll need to be very careful as long as the transaction on the shares of real estate companies take place, in order to know if special approach to taxation will be applicable. And this special way of taxation is the one that is described on this slide. So when we determine that transaction regards Polish real estate company, then as I mentioned previously, the right of taxation will stay with the real estate company and not with the seller. So this is completely new, because so far the transfer, the seller, was liable to tax, and right now this obligation is switched to the company being actually the subject of the transaction. The taxation will be 19% on the income realized on the sale. In certain cases where the real estate company will not have information on the value of the transaction, it will be 19% of the market value of shares being transferred. And this new tax mechanism actually may cause a lot of difficulties of practical nature, because here the real estate company will need to be equipped with the funds to pay the tax, because the proceeds from the sale will go to the seller, obviously, and not to the subject of the transaction. There will need to be a proper communication between the shareholder and the real estate company being the subject in order to determine properly the taxable basis. So that's another point. And this change will also, from practical point of view, will surely have impact on the transactions, on the transaction on the shares relating to real estates, because right now the acquirer, besides the normal due diligence procedure that will be conducted with respect to the company that is acquired, will also need to look on the seller, on the shareholder, whether or not, for example, the exemption from tax in Poland was properly applied. Let's say if the Luxembourg holding company was selling the shares, or maybe another example, if the company, for example, from the Netherlands, which still does not contain the real estate clauses selling, said that there should be no taxation in Poland because there is no real estate clause in the treaty. However, then the buyer needs to be sure that the seller was eligible for the exemption. So whether he was indeed a tax resident, he had a proper substance there, and there is a good justification, good business justification for the transaction. So to sum up, there will be certainly new risks for the buyer, and this can influence the way how these transactions are structured. So in some cases, acquisition of real estate itself may be more beneficial than acquisition of shares of a company that has real estates. And having a status of real estate company will have also certain, is connected with the need to fulfill certain notification reporting obligations. So such companies and their shareholders, direct and indirect, will need to notify the tax authorities in Poland about the fact who is the shareholder and how many shares are held in the real estate company, and this obligation will be imposed on the real estate company and on the directors. And still, it is unclear how far, on how many levels up in the shareholding structure, this reporting should relate to. Hopefully, this will be clarified in the future. Secondly, the Ministry of Finance, similarly with respect to the big taxpayers, so the ones which revenues exceed 15 million euro, will would make available to the public tax information, tax data on the real estate companies. So the information that are mentioned in the tax returns, like revenues, tax deductible cost, income loss, and tax due. And the third important aspect, but we don't believe that should have a big influence on because it might not happen that often in practice, but companies, real estate companies that do not have a seat or registered office management board in Poland, when the transaction on their shares take place, there will need to be a tax representative appointed in Poland in order to take care of settling the tax on behalf of the seller. It's important to know that this tax representative will not. There will be no such requirement for companies that are subject to tax in the EU, European Economic Area, etc. So it's only in the cases where the seat or management board of the real estate company is from a third country, let's say. So that would be the most important changes as far as real estates are concerned. I will switch now voice to Marcin to talk about the requirement to publish the tax strategy of the companies.
All right. Thanks, Michał, again. So these were, I think, so far we have discussed changes in the corporate income tax applicable mostly to smaller or smaller taxpayers or taxpayers operating in a specific legal form, or taxpayers having a very specific type of business, meaning real estate companies. The next change is directed at all of the largest Polish taxpayers. So, and this is basically the same group that a couple of years ago was subject to a new, let's say, a new duty, but in fact was subject to new informational disclosure, which was made in fact by the Ministry of Finance itself. So the local taxpayers didn't need to act in any way, but as you might recall, all the largest Polish taxpayers, defined as entities with revenues exceeding more or less 50 million euros, had their data published, their corporate income tax data published by the Ministry of Finance, meaning these types of data that Michał just mentioned. So tax revenue, tax costs, tax profit, and tax due. And this became a publicly available information, but in and of itself, I think it can be safely stated that in and of itself, these data could have been misleading in certain cases. They could have led to misinterpretation of the position or approach of given Polish taxpayers. For instance, taxpayers utilizing certain available tax reliefs, or taxpayers having a specific type of business, or conducting a lot of investment. They could have looked bad just solely based on the raw numbers presented, that they had a lot of revenue, a lot of profit, and perhaps paid a lot of tax without really any explanation without the right, or without the space for any explanation on how this happened. And now this change is the next step, directed at the same group of taxpayers. So the largest ones, about 2,800, I think, entities overall in Poland, who will have to publish a report on the fulfillment, report on the realization of their tax strategy. So basically, if your revenues in Poland exceed 50 million euros, you will have to publish this report on realizing your strategy on your website. This obligation basically will cover, or at least that's the way we interpret this, will cover the year 2021. So we read it this way: during the year 2021, all of the largest taxpayers will have to already have a tax strategy, most likely or preferably formalized tax strategy. And during the year 2021, there will be certain events, there will be certain occurrences which will impact this tax strategy. And after 2021, in the year 2022, in line with current regulations, I think, for most taxpayers until the end of 2022, such a report on the year 2021 will need to be published. This report will need to contain certain specific points listed in the legislation, certain very tangible items, like the number of tax rulings, the number of DAC6 or MDR reportings, the number of questions or rulings regarding VAT rates, etc., etc. But this report will also need to contain a description of tax processes, description of tax procedures, and description of how a given taxpayer approaches performing their tax obligations. This is a rather vague point, as can be clearly seen, especially when being compared to these other points, like a number of tax rulings, tax questions, etc., etc. But in our view, this is the most important. This will be the most important part. The sheer obligation of publishing tax strategy is nothing new for global entities. This has been an obligation in the UK or in the Netherlands for some time now. But in this specific form, it is something rather different. Again, as a Polish type of solution, basing on some foreign sources, where all of the largest taxpayers in Poland will need to clearly present what type of strategy they have and how this strategy was implemented in the year 2021. So what we advise is to, first of all, look at your business, look at your tax strategy, look at your tax procedures, and we know that in certain cases this has not been a priority for a lot of businesses. Usually the priority of business itself, of course, but we have witnessed, and we know a lot of our clients who for whom the tax department works well, who comply with all the tax obligations, but this is a sort of usual knowledge or common sense based approach without any formalized procedures, without any formalized documentation, etc., etc. And in these types of cases, we would recommend to take a look at the business, try to formalize, try to write down all these things that are being done, usually customarily, that are being done in a given way because they have always been done this way. We would recommend to really take a close look at all the aspects of a given organization, of all the levels, of all the layers, all the reportings or the filings, all the responsibilities of financial and non-financial staff, and try to just write it down, try to have it established as a common approach, common document, common tax strategy, in order to be able to comfortably, in the year 2022, just file a report on fulfilling this strategy, and not to start looking for answers in 2022 when it will be already, it can be already too late. So this is a big change for the biggest taxpayers, and this is also something that will make the tax strategy, whether it will make tax obligations, tax compliance, a public issue for the biggest taxpayers once again. So we really recommend taking a careful look at the tax aspects of the whole business, not only within the financial department, but also sort of across the business, where taxes meet all the other business functions. There is still time to do it, but we feel it's if possible, it would be best to start as soon as possible. And I think, yes, this was, as I promised, I was supposed to discuss mainly the positive changes. The last one wasn't perhaps that positive, but the next one definitely is. It has not been introduced as a draft law yet. This piece of the presentation is just a discussion about planned or communicated changes. We don't have any certainty as to in which moment this change will be introduced, but most likely it will happen next year. It's called relief for robotization because it will work in a very similar fashion to R&D relief, for instance, or IP box relief, meaning that a portion of costs incurred for defined items. These items now, as communicated by the Ministry of Finance, will be costs of purchasing robots or cobots, so collaborative robots, the next generation of robots, expenses for software, expenses for training. It should be imagined that these will be not generic software expenses or generic trainings, rather software and trainings related to robots and robotization, and similar additional expenses. Incurring these expenses will have an additional benefit in the form of the ability for a given taxpayer to treat 50% of these costs, of these expenses, as additional corporate income tax deductible item. So this is something that is planned to be in operation, to be functional for the next 4 years, so 4 or 5 years, between 2021 and 2025. and its impact on taxpayers benefiting from some tax exemptions is still not clear, because again, this is a very early phase of communicating this change. But this is again a next step after R&D, after IP box, after a special investment fund, Estonian CIT regime, another tool for the Polish taxpayers to have additional benefits stemming from tangible fixed asset investments. Let's put it this way. And I think now we can move to some smaller changes. The first one is COVID related, meaning that minimum tax on commercial real estate will still not be binding, will be postponed or revoked in the coming months. So this is again something positive for these businesses which face the difficulties of COVID related business implications. And another change, this is I think less positive, less so, is that but it also relates to fixed assets. This is a sort of twofold change related to fixed assets. First is that certain taxpayers who operate in the special economic zones or who are tax exempt will be denied the right to increase or decrease tax depreciation rates, which has been their right so far, and it has been utilized by numerous taxpayers. Right now, the government or the Ministry of Finance has perceived it as some sort of undue tax distortion, and this availability of changing tax rates, tax depreciation rates on various fixed assets will be denied for these types of entities. So entities being tax exempt on part of their revenue or operating in special economic zones. So this is some sort of closing of a loophole in the view of the Ministry of Finance. And another such closing of a loophole, I think, or this another change can be described this way, is the taxpayers so far had the right to establish their specific tax depreciation rates for used fixed assets. Now the definition of the used fixed assets is being changed. So far it has been an asset had to be used for 6 months by anyone, so possibly also by the taxpayer in form of a leasing arrangement, to be able to be then taken into the books of a given taxpayer and depreciated with a different depreciation rate. Right now, the obligation is for the asset to be used by somebody else, by a taxpayer different than the taxpayer who then introduces this fixed assets into their own books and depreciates with a special depreciation rate. So this is again something viewed by the Ministry of Finance as closing a loophole, which was perhaps utilized unfairly by taxpayers who leased an object for 6 months or 60 months, if it was a building, and then after this period introduced it into their books and depreciated with an increased depreciation rate, depreciated it faster. So this is again another change another smaller change, but perhaps with significant effects on various taxpayers in the corporate income tax regulations. And I think the following changes can be discussed by Michał.
Thanks, Martin. Continuing on other smaller changes, finally I have something positive. So the positive news is that as of the next year, in the CIT law, there will be an increase in the threshold, in the amount of income that allows to be qualified as an entity that is subject to reduced CIT rate of 9%. So far it was reserved only to small taxpayers and taxpayers beginning their business activities. However, the definition of a small taxpayer referred to 2 million Polish zlotys, but at the same time there was a threshold of 1.2 million euro that could not be exceeded to benefit from this lower rate. Right now, it looks like this threshold will be lifted. So as a result, more taxpayers will be able to benefit from this lower tax rate, which is definitely positive. But on the other hand, we have another change that is again subject at tackling tax avoidance and aggressive tax planning. Without getting into details, but right now, one of the provisions says that the company that takes over another company cannot utilize their tax losses of the disappearing entity, and right now, what is being put in place is a rule saying that if the company already has some tax losses carried forward from the previous years, will not be able to utilize them in order to set them off with the income of the company that was taken over or acquired or organized part of business that was acquired. In the case when after the acquisition, after this takeover process, the scope of activities of the company will partially or to the large extent change in comparison to what the company was doing before the merger or before the acquisition. So this regulation aims to address that situation when we had a loss-making entity that acquired another entity that was profit-making only in order to utilize the losses and not because of the business arguments. And another small change in the CIT law regards the distribution of assets in Poland. As you know, settlement of the liability resulting from different titles, either from the loan, from the dividend payment, etc. Can constitute a taxable event. So the amount of the liability that is satisfied with distribution of with a distribution that is a non-cash distribution, so distribution with an asset. So if we, for example, pay for a liability by distributing, let's say, building, the amount of the liability that we get rid of simply constitutes taxable revenue subject to tax in Poland. There was a discussion whether or not the assets that are distributed to the shareholders within the liquidation procedure, other assets than cash, also fall within this provision. And there was a dispute between tax authorities, administrative courts in this respect, the taxpayers. Right now, there is a close of the discussion in this regards, because such distribution of non-cash assets within liquidation will also be captured by CIT simply. As we are getting to the end of our presentation, as Martin said, there will be a question at the end, but just a couple of minutes to share with you about the withholding tax regulations. As you know, as of 1st January 2019, we have new rules on the withholding tax that are more restrictive. Relief at source mechanism was switched more into the pay and refund mechanism. However, there were quite a lot of voices and questions from the business that these regulations are actually hindering a lot of investments in Poland and are applying a lot of administrative burdens on the taxpayers in Poland. So as a result, the Ministry of Finance conducted a number of consultation meetings, and although there is still no official project, the draft bill on the changes of the withholding tax regulations, we can hear from the Ministry of Finance a number of positive news what will change, and these changes will the most important ones are the following: that right now this pay and refund mechanism will be applicable only to passive payments, so interest, royalties, and directives, most probably, depending how the new law will be structured, but this is the expectation. So the intangible services should be excluded from this pay and refund mechanism, and at the same time, the tax remitter should apply this pay and refund mechanism only to the payments to the related parties. So unrelated entities should be most probably excluded. And I think other important information is that these opinions that are right now available to apply exemption from the withholding tax that were right now restricted only to directive-based exemptions, right now will be extended also to payments that fall under the double tax treaties. So this is also good. And there will be a number of clarifications of definitions of the beneficial owner, of tax due diligence. So definitions that causes a lot of troubles and a lot of debate among taxpayers how to apply them in practice. So we should expect the draft bill being issued most probably by the end of this calendar year. And it will be followed by the explanations on the withholding tax regulations that we are waiting for. Right now, there was a draft published back in 2019, but after the amending bill will be introduced, there will be also explanations for taxpayers in order to help them how to interpret the new regulations. But overall, it seems like these changes are quite good, quite positive, and should allow the tax remitters in Poland to settle their tax liabilities easier, in a more easier fashion. And to end up, Martin, we'll have a question to you. We are interested in your view on the presentation and on the changes. So I'll pass the voice to Martin.
Yeah, perhaps even more about the changes that we have discussed rather than our presentation. As you can see, of course, there are again a lot of changes. I think we are doing these English-speaking webinars at least once a year, and at least every couple of years. The title of the webinar is basically another revolution in the Polish corporate income tax. So as you can see, these changes are also quite significant. I think that the nature of them, if I don't know if you agree, Michał, but the nature of them is such that they are sort of pinpoint, or there's one change, or one change, maybe two changes directed at each group of taxpayers. These are not all of them are the changes that are relevant for everyone, mm-hmm. Right? Like, for instance, here we have the real estate groups, we have smaller taxpayers, we have larger taxpayers, but not every change is available for everyone.
Yeah, but the good thing is that it's not only because so far we got used to the changes that were aimed at, let's say, fighting the aggressive tax planning, but there are also some the changes that Martin was presenting, legislative changes that are aimed at promoting investments, boosting the economy in the difficult times of COVID. So that's definitely good. Yeah.
Yeah, but I think you also discussed some positive changes, like the withholding tax, which has been one during some of our previous surveys. The withholding tax changes, I think, were the most troubling for everyone, and they are a very significant administrative burden for most of the taxpayers. Yeah, so a positive change, and I think the changes you have discussed are mostly, at least the plans for these changes in withholding tax are mostly positive. Positive meaning that they should limit some undue burdens on the taxpayers, right? Mm-hmm.
Okay. And from the survey that you answered the question, it looked like the biggest impact that will be on your businesses was connected with the requirement to publish the tax strategy and tax policy. Mm-hmm. So that looks like this is something that you see as something most impactful. There are quite a large number of answers with respect to the taxation of limited partnerships. But definitely this tax strategy is something new, as Martin said, new requirement. A lot of companies will need to get prepared to it. And there is quite a lot of number of taxpayers. You said above 2,000, right? Big taxpayers that could be affected. So, yeah, a lot of interesting changes in the law, and yeah, we're happy to help you to work with you in case there is assistance needed. Thank you very much for your attention this morning, and yeah, stay in touch.
Yeah, let's stay in touch. Thank you also for participating in the chat. And if you have any other questions, there are our contact details, as you can see at the end of the presentation. So we will also be, of course, coming back to you when these changes are finalized, either directly or via some other communication, perhaps some other webinars or tax presentations. So please, let's stay in touch, and hopefully we can manage through these difficult COVID times and these difficult changes in tax regulations as well in the coming years. So once again, thank you very much.
Thank you.